Let's bring in CNBC contributor Jeff Kilburg. He's founder and CEO of KKM Financial. Jeff, welcome. Give me your knee-jerk thoughts about this new bull market.
Well, it's remarkable, Kelly, and we've talked often about this post-midterm election year of 2023. We saw a lot of headwinds, and we finally are seeing the bears wave the white flag. You're seeing a little bit of mercy being asked for, but here we are. I have a short-term target of the S&P 500 going up another 3.5% to 4450 as we are in the month of June. You have to remember, there is a FOMO component, fear of missing out, but there's also end-of-quarter rebalancing. There's also some window dressing for all those money managers that are underinvested in the marketplace. So I think that pushes us higher here short term, but we have really gotten over a lot of these hurdles. We talked about earnings season. It was worse than feared. We talked about the debt ceiling. We got over that hurdle. So the traders in the VIX are revealing the fact that nothing for the next 30 days has bothered them. And you're seeing the VIX at 3-year lows with a 13 handle on it, Kelly.
I know, but the low was Feb 2020, and I just don't take that as like the kind of sign you want to be flashing right now.
Well, you're absolutely right. So some people look at this VIX this low, you can talk about complacency, but I'm taking the other side of the trade here because I have been cautiously optimistic all year. And when you see people not willing to pay for downside protection. Let's remember what the VIX is, Kelly. It's just an aggregate number. It's a statistical calculation revealing the fact that people are buying puts and calls and they're not overly concerned short term. We may have more headwinds and geopolitical tensions will rise later as growth continues to slower, but short term right now, we've won the race. The bears are waving the flag. They are getting pushed back into the hurt locker. So that's where I think we go up to 4450. And we are going to have, an ebb and flow of emotion coming into the market once we get past this quarter. So I think we see the market pull back here, but we are now experiencing higher lows in the S&P 500. And all those bears that were calling for the October lows to be tested, I don't hear from them anymore, Kelly. They've kind of tucked their tail and run away. What happened to the 3200, 3400 camp? So I'm not taking a victory lap by any means, but I am saying things are better than expected. The economy, the consumer, we're seeing strength in the earnings. Again, better than feared.
Their tail isn't that long. It's just like a little button tail. It's hard to
That's right.
Let me also bring in David Katz. He is CIO of Matrix Asset Advisors. And David, let me ask you the question and then read off a couple of stats. Are we in a bull market that's like the bull market of the 1980s and 90s that goes on for 7 years and returns 200%? Or are we in the bull market like we were in late 08, early 09, where we were just up 24% before resuming a downtrend? Or like we saw in 2001, similarly, only about a 20-25% move?
We don't believe it's a straight line, but we do think stocks are poised to go higher. We think the very important thing to point out about this rally from the October lows is while the S&P is up 21%, most areas of the market, an equally weighted S&P, small cap, mid cap, dividend stocks, value stocks, are only up about 14%. So you see that the market's doing better. You see it was impossible to predict before the fact. We think the rally is going to broaden out in a meaningful way, and we think there are lots of places to buy stocks now, even though stocks are up significantly from their lows.
Does it make you nervous, David, to bet on a broadening market, to get in on the momentum and everything now when you see things like jobless claims, usually a leading indicator of stocks starting to tick back up?
Well, Europe officially went into a recession today or this month, yet the stock market is up very significantly. So our outlook is that our economy could slow down. We could have a recession, but we do think stocks will go higher over the next 6 to 9 months. And importantly, there are lots of really good companies at 10 to 12 times earnings. So you're getting good companies at very reasonable prices. The other thing we're seeing is a great deal of insider buying. Insiders can sell for lots of reasons. They buy for only one reason. They think they're going to make money. So we take our cue from insiders and we buy the stocks that really haven't done a lot yet, rather than chasing the 7 biggest leaders that have been on a tear.
Right, and we could argue the macro all day long, but at the end of the day, you like General Dynamics, PNC, Tyson, U.S. Bank, PayPal, Paramount. I mean, these are picks that, will be kind of independent of whatever that argument ends up being. Just one quick follow-up question. Have we ever seen stocks not decline when a recession hits? Because that's basically what you're arguing.
Well, stocks went down about 20 to 25% last year in anticipation of a recession. We would say that stocks are now starting to recover based on the fact that it's going to be a modest recession, and they're looking toward 2024 where earnings are going to be on the mend and the economy is going to be on the mend.